1031 exchange is a powerful tax deferral strategy used by real estate investors to defer paying capital gains taxes on the sale of an investment property, provided the proceeds are reinvested into a similar or like-kind property. Named after Section 1031 of the U.S. Internal Revenue Code (IRC), the 1031 exchange allows investors to defer taxes on gains from the sale of real estate, essentially rolling over the gain into a new property. The 1031 exchange is a tax planning tool that can be especially useful for investors looking to grow their real estate portfolios without the immediate tax burden. However, there are specific rules and guidelines that must be followed for the exchange to qualify. Sell the original property, relinquished property. The investor sells a property that qualifies for the exchange, known as the relinquished property. This property must be held for investment, business use, or for productive use in a trade or business. The sale of the relinquished property triggers capital gains tax, but as long as the transaction qualifies as a 1031 exchange, the capital gains taxes are deferred. Identify the replacement property. After the sale, the investor must identify a new property, known as the replacement property, that they plan to purchase. The IRS allows the investor to identify multiple potential replacement properties under specific rules. Identification period. The investor has 45 days from the sale of the relinquished property to identify one or more replacement properties. Rules for identification. The IRS allows you to identify up to 3 properties, regardless of value, or more than 3 properties as long as their total value does not exceed 200% of the value of the relinquished property. Another option is identifying as many properties as you like, provided their combined value does not exceed 200% of the relinquished property's value. Close on the replacement property. The investor must complete the purchase of the replacement property within 180 days from the sale of the relinquished property. This means the entire process, sale, identification, and purchase, must occur within a 6-month period. Reinvestment of sale proceeds. To fully defer taxes, the investor must reinvest all proceeds from the sale of the relinquished property into the replacement property. This includes both the net sale price, the amount the property is sold for minus selling costs, and the equity, the amount of money the investor originally invested. If the investor takes any proceeds from the sale of the relinquished property, called boot, the amount taken is subject to tax. Boot can include cash, debt relief, or other property received. Qualified intermediary. The exchange must be facilitated by a qualified intermediary, QI, a neutral third party who holds the proceeds from the sale of the relinquished property until they are used to purchase the replacement property. The investor cannot have direct control over the sale proceeds at any point during the process, or the exchange will be disqualified. Key requirements and rules for a 1031 exchange. Like-kind property. The term like-kind refers to the nature or character of the properties, not the quality or value. In a 1031 exchange, the relinquished property and the replacement property must both be held for investment or productive use in a business or trade. For example, an investor can exchange an apartment building for a commercial office building or land for rental property. Real estate only. A 1031 exchange applies exclusively to real estate. It does not apply to personal property like machinery, equipment, or collectibles after the tax law changes in 2018. Both the relinquished and replacement properties must be real estate, land, buildings, etc. Personal use property. Properties used for personal purposes, such as a primary residence or second home, do not qualify for a 1031 exchange. Like-kind exchange example. Example, an investor sells a rental property worth $500,000 and purchases a new rental property worth $600,000. If the investor follows the 1031 rules, they can defer the capital gains taxes on the $500,000 sale and avoid taxes on the appreciation, provided the new property is of equal or greater value and all proceeds are reinvested. 180-day deadline. The investor has 180 days from the sale of the relinquished property to close on the replacement property, which is a hard deadline that cannot be extended. This time frame is critical, and failure to meet it disqualifies the exchange. Equal or greater value. The replacement property must be of equal or greater value than the relinquished property to fully defer capital gains taxes. If the investor purchases a less expensive property, known as downsizing, the difference, or boot, is taxable. Debt relieved. In addition to reinvesting the sale proceeds, the investor must also account for any debt relief. If the debt on the replacement property is lower than the debt on the relinquished property, the difference will be considered boot and subject to taxation. No cash out. One of the critical rules of the 1031 exchange is that the investor cannot pocket any cash from the sale. All proceeds must go toward purchasing the new property. If an investor receives any cash boot, cash left over from the sale that isn't reinvested, they must pay taxes on this amount. Use of a qualified intermediary, QI. The investor cannot have access to the sale proceeds at any point during the exchange process. Instead, a qualified intermediary, or a third-party intermediary, holds the proceeds from the sale of the relinquished property and facilitates the transfer of funds to the purchase of the replacement property. Benefits of a 1031 exchange. Tax deferral. 1. The primary benefit of the 1031 exchange is the ability to defer paying capital gains taxes on the sale of the relinquished property. By reinvesting the proceeds into a new property, an investor can defer the tax liability indefinitely, potentially until the final sale of the replacement property. 2. Portfolio growth. The 1031 exchange allows investors to build wealth over time by enabling them to trade up to larger or more profitable properties without being immediately taxed. This ability to defer taxes means more capital is available to reinvest, growing the investor's portfolio faster. 3. Diversification. Investors can use the 1031 exchange to diversify their real estate holdings. For example, they might sell a single-family rental property and purchase several multifamily units, or invest in a completely different market, e.g., from a residential property to a commercial one. 4. Depreciation recapture. In addition to deferring capital gains tax, the 1031 exchange also allows investors to defer depreciation recapture taxes. Depreciation is a tax benefit available to property owners, and when a property is sold, the IRS may impose taxes on the amount of depreciation claimed. A 1031 exchange allows this tax to be deferred as well. Potential risks and considerations. 1. Strict deadlines and procedures. The 1031 exchange process is time-sensitive, and missing a deadline can disqualify the exchange. Investors must be meticulous about following the identification and closing timelines. 2. Complexity. The rules governing 1031 exchanges can be complex. Failure to comply with all the requirements, such as using a qualified intermediary, following the proper identification rules, and adhering to the 180-day window, can result in disqualification and trigger tax liability. 3. Depreciation recapture. While a 1031 exchange allows for deferral of capital gains taxes, it does not eliminate them. Eventually, when the investor sells the property without engaging in another 1031 exchange, the taxes on the accumulated gains, including depreciation recapture, will become due. 4. Market risks. While a 1031 exchange provides tax deferral benefits, it does not protect the investor from market risks. If the replacement property loses value, the investor may not realize the expected return on investment. 5. Transaction costs. There are costs associated with executing a 1031 exchange, such as fees for the qualified intermediary, closing costs, and any other transaction-related expenses. These costs need to be factored into the overall profitability of the exchange. A 1031 exchange is a valuable tool for real estate investors who want to defer taxes on the sale of a property and reinvest in another one. The ability to defer capital gains taxes allows investors to preserve more of their capital and continue growing their real estate portfolios. However, to take advantage of the exchange, investors must strictly adhere to IRS rules and deadlines, work with a qualified intermediary, and ensure the properties involved are of like kind and held for investment purposes. While the 1031 exchange offers significant tax advantages, it also involves complexities and risks that investors should carefully consider before proceeding.
If you found this video helpful, be sure to hit the like button and subscribe to the channel. Until next time, this has been The Long and Short.